Hey everyone, welcome back to Corporate Growth, the place where we help you make sense of financial jargon and what it means for your investments. Today we're unraveling a recent filing from CoreWeave Inc. and let's just say they've been busy securing some significant funding. Imagine a company essentially borrowing a huge sum of money to fuel its growth. That's pretty much the story here. So what's the big news? CoreWeave, a company that's been making waves in the computing world, has just completed a massive debt offering. They've essentially borrowed a CoreWeave is cooking up. Let's dig into what this means. They've issued what are called senior notes, which are basically promises to pay back borrowed money with interest. These particular notes are due in 2031, meaning they've got about 7 years to pay this massive loan back, and they're paying a pretty hefty interest rate of 9%. That 9% interest rate is important because it tells you how much the company is willing to pay to access this capital. It's a clear indicator of how much they believe in their future prospects and how much they need these funds. Now, what are they doing with all this money? The official line is for general corporate purposes. Think of that as pretty much anything the company needs to spend money on. A big chunk is likely going towards paying off other debts, which is a smart move to consolidate and potentially get better terms. Plus, there are always fees and expenses tied to these kinds of massive financial maneuvers, but general corporate purposes can also mean investing in new technology, expanding their operations, or even making strategic acquisitions. Given CoreWeave's focus on cloud infrastructure and AI compute, this money is almost certainly being poured into expanding their data center capacity and upgrading their hardware to meet the booming demand for AI processing power. To break down that interest payment schedule a bit further, the company will be paying 9% per year, but they'll do it in 2 installments twice a year. So every February and August, they'll be sending out significant interest payments to the note holders. This means they need to be generating a steady cash flow to cover these obligations and avoid defaulting. It's also important to note that this borrowing isn't just on the back of the parent company. Certain of their fully owned subsidiaries are also backing this debt. This means that if CoreWeave itself can't pay, these subsidiaries' assets could be on the hook. This is standard practice for large corporations to spread the risk and provide more security to the lenders. It also suggests that these subsidiaries are profitable and have valuable assets. Now let's look at some of the details of these loan agreements that give CoreWeave some flexibility. They have the option to pay back some or all of these notes early before they're officially due. However, if they do this before early 2028, they'll have to pay a make-whole premium. Think of this as a penalty for paying back the loan sooner than expected. This premium essentially ensures that the lenders still get their expected return even if the company decides to refinance or pay off the debt early due to better borrowing conditions later. There's also a provision about a change of control. This means if something major happens, like the company is bought out or merges with another company, the people who lent them the money have the right to demand their money back sooner, and they get a little extra 101% of the original amount plus any unpaid interest. As a sort of thank you for the trouble, this is a protection for the lenders to ensure they aren't stuck with a loan to a company whose ownership or structure has changed drastically in a way they didn't anticipate. This section is crucial for understanding the constraints CoreWeave is now operating under. The document called an indenture lays down the law for how the company can operate while this debt is outstanding. They've basically agreed to a set of rules. For instance, they can't just go out and borrow more money easily, issue new kinds of stock without restrictions, or pay out large dividends without careful consideration. They also have limits on selling off parts of the business or making major investments without first consulting with the lenders or meeting specific conditions. This is all about ensuring the company remains stable and capable of repaying the $1 extensions. This is all about ensuring the company remains stable and capable of repaying the $175 billion rate freely, volatile from 7 off parts of the business or making major investments without first consulting with the lenders or meeting specific conditions. This is all about ensuring the company remains stable and capable of repaying the $1.75 billion to operate freely. Now, to let the world know about this big financial move, CoreWeave also released a press statement on July 28. This is what's called a Regulation FD disclosure, which just means they're making sure all investors get the same important information at the same time to keep things fair and square in the market. This press release officially announced the successful closing of their note offering. It's their way of saying, we did it, the money is in, and we're ready to put it to work. Investors and the market alike will be watching closely to see how effectively CoreWeave deploys this significant capital infusion. And finally, the filing is signed off by their CEO, Michael Intrater. This is the formal end of the document, but it's the beginning of a new chapter for CoreWeave, one that's now heavily capitalized and, as a result, subject to more scrutiny and financial obligations. So let's put on our Warren Buffett hats for a moment. CoreWeave is essentially taking on a massive bet on its own future, specifically on the continued exponential growth of AI computing demand, by securing $1.75 billion to capture a significant share of this market. The 9% interest rate is a clear indicator of the market's perception of their risk profile and the company's own assessment of its future earnings power. They're willing to pay a premium for this capital, which suggests they expect future returns to far outweigh the cost of borrowing. A key strength here is the timing. AI is the hottest sector right now. And companies like CoreWeave that provide the underlying infrastructure, the computing power, are perfectly positioned. This funding allows them to scale rapidly, build more data centers, and acquire the latest high-performance hardware. However, the significant debt also presents a major risk. If the AI market doesn't grow as rapidly as anticipated, or if competition intensifies and erodes profit margins, CoreWeave could find itself struggling to meet its debt obligations. Those semi-annual interest payments of 9% will be a significant drain on cash flow. The restrictive covenants in the indenture, while protective for lenders, also limit CoreWeave's strategic flexibility. They can't pivot as easily if market conditions change unexpectedly. In conclusion, CoreWeave is making a bold move. This $1.75 billion debt offering is a powerful statement of intent to dominate the AI infrastructure space. The company's success now hinges on its ability to execute its growth plans efficiently and profitably, translating this borrowed capital into substantial future earnings. The coming years will be critical to watch as they manage this substantial debt while striving to meet the insatiable demand for AI compute. What's your take on CoreWeave's massive borrowing? Does it signal brilliant foresight or a high-stakes gamble? Let me know your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and be sure to subscribe for more in-depth corporate analysis. And for even deeper dives and community discussions, join our Discord server linked in the description. Thanks for tuning in to Corporate Decoder. See you next time.